Hello and welcome. My name is Shahrukh Abdali. I'm a financial advisor at Saturn Advice. This is the July update. I'll encourage you to pause the video and have a look at the disclaimer, but there's quite a bit to cover, so I'll move on. Inflation, as we've been talking about in past videos, now seemingly getting under control. Previously, you might recall US inflation appeared to be moving sideways, but I had pointed out previously that the core inflation is trending downwards, and core inflation is more representative of the long-term trend in inflation. So the headline inflation, sorry, you can't read the figures, they're a bit too small, but I'll talk you through those. In the top left, I've shown the US inflation, and the latest figure as of June came at 3%, which is not too far from the target of 2%. And as per the US Federal Reserve policy announcement this morning and the press conference by the chairman, Powell, he suggested that this time around the decline is of higher quality because it's not just driven by a disinflation in goods, but also softening of inflation in services. So this time around, the decline in inflation is more broad than previous decline. So you can hope that it is going to continue to decline, and definitely there's a softer tone in terms of the policy outlook by the US Federal Reserve, as per the press conference this morning. I've also shown for comparison some of the other countries. New Zealand inflation in the top right has been declining quite consistently, as you can see. And the latest figure that came for the June quarter was 3.3%, which is actually pretty close to the 1 to 3% band target for RBNZ. So policy is working and is encouraging signs, at least on the inflation front for New Zealand. I've also shown Australian annual inflation in the bottom left, and it was declining pretty much like New Zealand, except for the latest figure for June came at 3.8%, which was slightly higher from 3.6% the previous reading. So it's a bit of a slight concern why there has been an uptick. But again, the core inflation for Australia is still trending down, so you would expect that the headline inflation would follow suit, and this would be just a temporary blip in headline inflation. But there are places where the inflation target has already been achieved, and I've shown the UK annual inflation rate at the bottom right, and they're already there. The inflation for the last two readings was at 2%, which is the target. So they've already achieved the target. So you can infer two things from this. One, the restrictive policy stance from central banks has been working, and it's successfully bringing down inflation, and in some cases already brought it down to target. And secondly, with the target in sight or already achieved, you would expect that the policy would be eased from the restrictive stance currently, which is what you can hear from all the headlines around. As per the press conference this morning, while the Federal Reserve did not specifically point out when they will proceed with the first cut, it was very much implied that they're not too far from it, and the September meeting, which is the next one, is going to be when we will see the first cut from the US Federal Reserve. Locally in New Zealand, as I've said, the inflation is not too far from the target band. Quite interestingly, I've been saying this on my monthly videos that I see interest rate cuts this year, even for RBNZ and for the US as well. And RBNZ, until the latest policy statement, seemed to suggest that they can't see a cut happening until some point second quarter or so next year. But as per the latest statement, they have softened their tone following the encouraging inflation figure, and now they expect to cut earlier, which would be taken as a cut coming this year. The question now is whether there'll be one cut or there'll be more. November is definitely on the cards to be a cut, but there are expectations that we might see a cut before that. There are even voices which are suggesting that we would see a cut as early as this month, later in August. But we'll see. Don't know as yet. Bank of England is expected to announce its rate decision within hours of me recording this video. So by the time you see this video, they would have decided, and the expectation is for them to do a first cut of their interest rate in the present interest rate hiking cycle. Which is looking more likely because of the softer tone coming out of the US Federal Reserve earlier today. I didn't mention this in my last month's video, but Canada became the first G7 nation to cut interest rate. That happened in June and was closely followed by the European Central Bank. So it's not just about banks, central banks looking to cut interest rates in the near term. Some central banks have already embarked on the journey and have started to cut their official rates. On the flip side, you've got an outlier in the Bank of Japan that has recently lifted its official rate, but they have certain issues to deal with, and it's an outlier case. For the US economy, previously I have pointed out that there are signs of softening, but there is resilient growth, and that resilient growth was primarily driven by strong consumer spending, which in turn was driven. That was the theory, that it's been driven by excess savings from pandemic days. I've shown the excess savings in the top left chart, and you can see those savings have been steadily depleted around about the first quarter, end of first quarter this year. So consumers have used up most of their excess savings and have actually gone overboard with their spending. And that has started to result in an uptick of debt delinquencies, credit delinquencies, as I've shown in the top right graph. Obviously, you can see the big hill there around about the global financial crisis. Credit delinquencies were really high at the time, financial stress, and there was a bit of an uptick around about COVID, the early days of pandemic, and now we have started to see a slight uptick in delinquency rates again. However, these are just pockets of softening, and all they do is they are pointing towards the success of restrictive policy, slowing down the economy and in the process bringing down inflation. But the economy is still in good shape, and that can be seen in the bottom left graph where I've shown the US GDP growth rate. The latest figure, the June quarter annualized GDP growth rate, came at 2.8%, which is much higher than was expected. So the US economy is actually still in a pretty good shape despite the slowdown in consumer spending, despite some layoffs happening, unemployment rising, delinquencies beginning to rise. The economy is still churning at a decent clip, and that is expected to result into profitability growth, as I've shown in the bottom right. The corporate America profit outlook is improving, and is the companies are expected to earn more. What's been happening in the financial markets? Last month, I addressed that the rally in S&P 500 has been very narrow and has revolved around a handful of companies, within the AI theme, and it was expected that this rally will broaden out, and these handful few companies will go flattish, and the rest of the market is going to participate in the rally and will drive the market forward. And that's exactly what seems to be happening now. S&P 500 had a positive month, shown that in the top left, 0.86% for July, but the S&P 500 equal weighted index, shown in the bottom left, did 5.2% over July, which clearly shows that it was rest of the S&P 500, other than the handful few AI companies that drove the market forward. And you might recall over the recent few months, I have been pointing out the smaller cap as a place to be and having the potential to outperform. And that is shown in the bottom right, Russell 2000, which is representative of the smaller companies in America. The index returned 11% through July. So the forecast is beginning to happen, is beginning to come true for smaller cap outperformance. Whether that continues or not, I'll come to that shortly. I've also shown NZX 50 in the top right, had a pretty decent month at 5.5% for July, largely driven by RBNZ softening its tone against a backdrop of encouraging inflation figures and declining interest rate provides a tailwind for valuations, and that is seen in NZX 50 performance over the last month. Now, going forward, I think this broadening of the rally has more legs because despite last month outperformance by the equal weighted index, the ratio of S&P 500 to the equal weight is still historically very, very high. The chart in the top left shows that ratio was the highest going back 21 years. But this is going back a few weeks. You can see at the rightmost of that blue line is beginning to drop. So that ratio is dropping, and that's representative of what's happened in the last month. However, there's still room for it to happen. So what's likely to happen is that the top big tech companies in the AI team are going to have a flat performance period while the rest of the market sort of catches up and other sectors drive the market forward. S&P 500, 493 companies, apart from the Magnificent Seven, their profit outlook has turned positive for the first time in 6 quarters and expected to improve going forward. In the meantime, the income outlook for Magnificent Seven is normalizing lower, but despite the normalization lower, the expected earnings growth rate for Magnificent Seven is still going to be higher than the rest of the S&P 500. So again, reiterates, it's not like those big Magnificent Seven companies are going through the floor. It's just that the valuations are so, the recent rally has been so strong, the valuations are priced for perfection. It's the upside is going to be a bit tough to come by, but doesn't necessarily mean that there is major downside to those companies. So it's going to be a flat period for the Magnificent Seven, in my opinion, and the rest of the market is going to drive things forward from here. I'm not going to dwell much in that. The video is getting a bit too long, but yeah, it's the same story that I've talked about previously. Small caps still have room, high dividend paying businesses, fixed income is still looking good. Diversification is the key. Please come talk to us. We specialize in this. We've got some really experienced advisors on board who would love to have a chat free of obligation to discuss your financial goals and objectives and help you get there. Here are the details. Take care. I'll talk to you in a month. Bye.